Nilesh Shah, the MD of Kotak Mahindra AMC and of course a star on a social media platform X, came out and responded to that comment saying that I had written to Jim Rogers in 2017 when he was bearish on India, and I'm glad he's understood it. So let me get Nilesh Shah into the conversation. Mr. Shah, great to have you on the show and, sort of round up this whole conversation. And big of Jim Rogers to say that he's embarrassed that he missed it, he made a mistake. I think a lot of global investors may be sitting on the sidelines with that absolute concern. And just the second part of what he said, I don't want to climb onto a moving bus. If you can start by addressing those 2 points.
So undoubtedly, when you jump on a moving train or a moving bus, you will get hurt. But is market going to be kind enough so that it will lay a red carpet for you to invest into? Equity market is about taking risk, about taking calculated risk. I will request Jim Rogers to come and visit Churchgate Station and see how Indians jump into a moving train. Maybe there is a trick for him to learn.
No, so, okay, Nilesh, your cryptic humor sometimes our viewers might not get when you make that analogy with Churchgate Station. So are you saying, because a lot of global money is still sitting on the sidelines and valuations is a story that we hear every day, are you saying that, it's time for them to get on board?
So my recommendation to investors is, India is like any other market. It will neither disappoint an optimist nor disappoint a pessimist. If you want to be bullish on India, we'll give you 10 reasons. If you want to be bearish on India, we'll give you another 10 reasons. In fact, I wrote a letter to Jim Rogers in 2015 as well as 2017 when he was only talking about the negatives of India. He's a legendary investor. And somewhere as an Indian, I felt, not as a fund manager, but as an Indian, that you don't come and berate my country in my media. You speak balanced things. You speak positives, you speak negatives. The whole intention was to present the true picture. I'm glad that finally he has realized it. Even today, his observation that India is a moving bus is absolutely right in certain kind of stocks. We have been also highlighting that there are many low-floating stock counters where valuation looks unreasonable. There's a momentum over there, and you are unlikely to make money over a longer period of time. But at the same time, there are many good companies available at reasonable prices. It's not a cheap market, but gold will always be available at the price of the gold, not the copper.
So India is Sona. So आप तांबे के rate मत expect करो. Having said that, even as we're speaking today and just now, Nilesh, fresh highs on the Nifty, on the Sensex, record levels have been hit. And, the message for those who are seeing this with a bit of butterflies in their stomach. Every day, there is also a conversation about whether these levels are sustainable.
So if you're taking 3 months, 6 months, 9 months, 12 months view, I have no idea whether these levels are sustainable or not. Today, there is Triveni Sangam of flows, fundamentals, and sentiment towards India. Domestic investors are powering in money, and it may create some kind of excesses, as we have recently seen in some of the IPOs. Do those IPOs deserve that kind of valuation and money? My answer is clear no. But then this is the market. It can remain irrational more than I can remain solvent. On the other hand, there is also fundamentals which is reflecting corporate earnings growth. Between 2020 to 2024, earnings have jumped almost 4 times from about 4 lakh crore to 16 lakh crore. Corresponding, there is jump in the market as stocks are slaves of earning. Now, over 5-year, 10-year horizon, are these levels sustainable? My answer is undoubtedly yes. I think when you're investing in equity market, you look at valuation, not necessarily the index. Are our valuation at lifetime high? Well, answer is clear and unambiguously no. They are still at reasonable sense in large cap, little expensive on small and mid cap, and hugely expensive in some low floating stock counters. Maybe 25% of market is frothy. 75% market still provides opportunities for long-term investor. Of course, you'll have to reduce your return expectation. If we see 20-year period between 2005 to 2024, the broad market return is about 13% plus, not a very unusual number. But 5-year or 4.5-year number from Jan 20 to 2024 is roughly about 21%. Before that, for 15 years, market delivered just about 11% return. So do moderate your return expectation. Go for quality over momentum. Go for high floating stock market discovered prices vis-a-vis low floating stock and controlled discovery of prices. Go for reasonable valuation over expensive valuation, and you will still do well in India at this level of index.
Nilesh Shah, it's also Samina joining in. Very clearly, we've borrowed returns from the future. You're right, the 10-year CAGR on the index is 12-13%. That's pretty much as well as gold has done. And I want to get a view from you on gold, because while you believe that there is opportunity to buy gold-like stocks in India, what do you think about gold? Without the in and outs, without the volatile returns, this one has done as well as the index. From where we stand right now, would you recommend adding gold to one's investment portfolio? Not significantly, but at least to the tune of 10 to 20%?
So, Samina, we have been advocating gold investment since March 20. Partly it was driven by correction during COVID time. Thereafter, Russian foreign exchange assets getting frozen by Western world pushed us to advocate gold even more strongly, as we believe central banks around the world are going to invest in gold. Now we believe as Fed starts cutting interest rate, there will be another boost to the gold prices. Obviously, the big Damocles sword hanging on gold prices was import duty. It has come down in the recent budget. Now the import duty is just about 6%. So we continue to advocate buying of gold. But Samina, I want to talk about one thing which should concern especially women buyers of gold. In many families, in many households, women go out and do Vichy or a SIP kind of investment with gold jewelers. You give small amount of money for 11 months, and then on the 12th month, you are able to buy ornament. Now, many a times, these jewelers are not reliable. Their credit worthiness is not established. This deposit of money is not covered under any regulation. And we have seen sometimes jewelers running away with investors' money. So please be very, very careful. Might as well do SIP in gold ETF than doing with roadside jeweler. The second thing is our tradition in houses on Diwali day, on Dhanteras day, on Akshay Tritiya day. We all go and buy gold. On a birthday, anniversary, we go and buy gold in small quantum. Now, when you buy gold in 1 gram, 2 gram, 5 gram, the transaction cost which you pay is 20, 30, 40%. It doesn't make economic sense to buy gold in smaller quantum. Might as well buy that via gold ETF or gold fund of fund. So gold, we are bullish, but I think we need to recognize that buying of gold, the habit of buying of gold needs to change. Instead of small denomination paying 30, 40% transaction cost, might as well come into gold ETF.
Of course, with the fact that SGBs are not showing up anytime soon, gold ETFs may be the way to do this. You know, one more factor that some may argue could be concerning, others may argue it improves the balance sheet of companies, is promoters selling significant stake. It's at a multi-year high. Year to date, promoters have sold over 1 lakh crores of equity, their equity in the market. One way to look at it is that they believe that the stock price of their company is peaking out, so they're taking profits off the table. The second way to look at it is whatever supply comes in, it gets picked up and lapped up not by just retail investors, but by even foreigners and mutual funds like yourself. Nilesh, is that a concerning trend? How are you reading into this?
So, Samina, your point is absolutely valid. Whenever you see promoters selling, you need to do your research 2 times more because he knows infinitely more about his company and valuation than you will know. Now, what we are seeing is that today, yes, undoubtedly, some promoters are selling, but many a times they are just setting up their family offices and their money comes back into the same market, albeit in a different stocks, different asset classes, purely from a diversification point of view. Second, we are also seeing some promoters who wants to fund their extended families or next generation's business ambitions. They don't want to create cross-holding like it was the trend in the past as it destroys shareholder value. They are selling their stake and putting that capital to use in supporting business ambition of their extended family and next generation. Third, we are also seeing family transition. Couple of friends have come together to start a company. Two brothers have come together to start a company, but their kids are not willing to work together. And hence, someone who is classified as a promoter, but who doesn't want to be a promoter is on his way out. We are also seeing some of the foreign companies coming and reducing their stake in India. So each promoter case, one has to look at carefully. If you find a promoter selling because he believes his company is overvalued, then you have to retest your hypothesis, do your due diligence, do your work more, and try to be understanding why promoters are selling.
Which is always tough to find out, right, Nilesh? Sitting outside, you really don't know whether they're selling for transitional purposes because they're diversifying, putting the money in wealth in a family office, or simply transferring to the next generation. But just moving on from that point, another thing that catches my attention often is the fact that everyone likes banks. Everyone's talking about how private banks is a good trade, but the trade is not playing out. What, in your opinion, is restrictive or restricting, rather, the private sector banks at this stage? And also, you started this conversation by saying there is some value in the market. So, don't paint everything with the same brush. Do you think private banks have that value that investors are seeking from a 1 to 3 year time horizon?
Undoubtedly, yes. But as of today, momentum is against private sector banks. One, their NIMs are coming down as cost of deposit is going up, and they are not able to pass that to the borrowers. Number two, there is a consultation paper on liquidity coverage ratio. If that gets implemented, it is likely to hurt private banks' profitability as they will be putting more money for liquidity coverage. Combination of slowing or reducing NIM along with potential reduction in NIM thanks to allocating more money for liquidity coverage is right now constraining private sector banks' valuation as well as the stock prices. We believe once the liquidity coverage ratio guideline is behind us, its impact factored into the prices, there will be opportunity to add private sector banks and select PSU banks.
Nilesh, we talked a bit about banking and financials, but just want to get your sense on one big trend that we have been seeing in the markets and whether you think that that story is over. This is the push for anything which is premium. Premiumization, discretionary spending, catering to a smaller part of the population, but one that wants to spend more on not just the basics. Do you think that that's a trend to stay, looking at our population demographics?
So again, every story is bottom up over there. We still believe premiumization trend will continue in the economy. But there could be disappointment in the market as market is factoring in certain level of growth, which may not materialize. If you look at entire consumer basket, I think time has come for mass market product to move, but for those companies which are able to leverage distribution. Through Pradhan Mantri Gram Sadak Yojana, more villages have been connected. Now our company is expanding their distribution network to take leverage of that connectivity. We have seen some established player moving more like a tortoise and some young guys moving like hare and establishing distribution network. The second thing is about cost proposition. There was a time when a global brand will always command a premium. Today, there is value conscious consumers which are willing to experiment with value for money brands. The third thing is also appeal to the user segment, consumer segment. We have seen many global brands, old brands, not able to maintain connect with the younger generations, millennials. So I will say premiumization story will continue to play in economy. In market, try to be bottom-up stock picker, especially with companies which are expanding their distribution network, which are able to maintain connect with the new set of consumers, and which are providing, in some sense, value for money. As one of the very popular advertisement of an automobile says, even if you buy luxury car, the question is, kitna deti hai?
Typical, right? Very quick one, Nilesh. For a very long time, IT, which has always been and has always managed to do strong returns over the last decade, was in a little bit of a back foot. And there were unprecedented times, right? They had not seen anything like a delayed, extended slowdown in the US. Of course, now we've got the US elections, threat of AI. But there were some parts of the market that believe that legacy businesses, legacy clients will come back. There's no keeping a TCS, HCL Tech and Infosys down for too long. Where does your bias stand? Do you feel like this AI threat could have been overdone and it's maybe not a bad idea to bet on the dark horses in that sense or the legacy players in the IT pack, or would you stay with the newbies, the guys in the broader market IT pack, tier 2 IT stocks?
So we believe in IT companies which are equipping their workforce with AI tools and helping create faster, cheaper, better solution for their customers are likely to survive, are likely to become winner. We have heard many commentaries which says in today's world, one person with AI tools is able to deliver almost 10 people's work. Software is getting commoditized. With AI and Gen AI, the value added will be more like people who are using AI tools rather than not using AI tools. At the same time, there is exciting opportunities opening on the hardware side. The Internet of Things, the AI getting built into hardware. So we'll have to see which companies are able to make that transition. Software getting commoditized versus hardware opening up new vistas. Companies which are able to make that transition, I think they will be the winner in this cycle.
Nilesh, I just want to get your take on an important notification from SEBI recently, which was sort of, a warning for investors in SME companies, talking about how promoters are, and that's a trend that SEBI is looking at, promoters are putting out news or sort of talking up the operation, stock price goes up, investors come in, and then the promoters are dumping their stock or their share. Just, these are sort of the beginning signs of trouble coming ahead. How do you see it? And is this something that we can now control quickly at the level of maturity we are at in our markets?
So, Tamanna, there is a Gujarati proverb which says, Lobhya hoy, tyan dhutara bhukhe na mare. Where there is greed, the thieves don't have an off day. It's applicable in the market. In SME exchange, there will be some good companies, no doubt about it. But as of today, there are also some bad apples from a valuation point of view. If we go to any SME banker, any SME entrepreneur, they don't say the last 10 years were the best of their life. However, SME index IPO is the best performing indices in the world. If your equity indices are doing so well, undoubtedly it should be corroborated in the real life also. I believe prices on SME exchange in many cases have gone up substantially ahead of their fair value, and hence SEBI's warning is appropriate. At the end of the day, it is buyers who have to be aware that if price is what you pay and value is what you get.
All right, thank you so much. Always fun and a pleasure speaking with Nilesh Shah. I mean, no one can beat you at the dialogues, the proverbs, and the sayings that you put in to make it a really enjoyable experience, not just for the viewers, but for us also to talk to you.